Hello, listener, and welcome back to the Rural American Surgeon Podcast. I'm your host, Dr. Randy Lehman. We're in our financial mini-series. This is episode number 3. Our first episode was about purpose. What's the point of money? What's the point of trying to create financial independence in the first place? Episode number 2 was more about frugality and its more inspirational upgrade counterpart, in my opinion, which is minimalism. So explaining how stuff kind of ties you down and limits your freedom, and just changing the mindset on what exactly the overall goals are, and also understanding how basically frugality and value of your own time, your own energy, and the resultant money that you're generating by expending your energy can be treated in a way that you give yourself a margin. And that brings us into this episode, which is about investing. This is not investment advice. I am not a financial advisor. I'm a surgeon with a deep interest in making my money work wisely, because I've learned that money either works for you or you work for money. And Warren Buffett has a quote that says, if you don't learn to make money while you sleep, you'll work until you're dead. I think that most people that have the opportunity to get financially independent. We talked about last episode, the 4% rule, and just sort of the concept of getting your net worth to a point where you can pull out 4% per year and considering yourself financially independent as long as your spending is below that threshold. And therefore, your freedom is determined a lot more by your spending than it is by your income or your net worth or any of your investing results. It's more about your spending. That being said, you could take that mass of money that you have, whatever your net worth is tied up in, and it could be all tied up in your personal residence, right? And you're not financially free at all, right? Because it's not generating any return. So you can't pull that out indefinitely. You could have it tied up in a lot of other things like, that don't necessarily generate a return. A cryptocurrency, actual precious metals, maybe you have art investments, maybe you own stocks and bonds, but maybe they're growth stocks and bonds rather than dividends, or you've got your real estate investments. Depending on what you're doing, 4% rule again may or may not apply, but it's a good place to start. And it's a good understanding that you need to start basically tracking your net worth. I track my net worth monthly on a big Excel spreadsheet that has really turned into quite the work of art itself over time. But it's a lot of fun to watch it grow and to understand like the activities. The best thing about tracking your net worth on a monthly basis is that you understand all the activities that you do throughout the month and how those are going to contribute to your net worth. You're standing at the store and you're thinking about buying something, and you know that dollar amount is going to show up in your net worth the next month, right? And so if you're kind of holding yourself accountable, and the most important thing that I think most people, they just close their eyes and keep the accounts closed, and they don't really know where they're at. But what we're talking about today is investing. So investing conceptually means take your money, try to make it work for you, and get a return. So turn $1 into $1.50, right? And that is different than take an hour of your time and trade it for money, so that you can then take that money and go buy the things that you have to live, or the things that you want, and then go back down to zero. Again, like this should be, I would say, considered maybe inspirational for you to go educate yourself more and not investing advice. There's such a thing as a certified financial advisor. The problem with that is there are things that the financial advisor can or cannot do, right? And for the most part, financial advisors are going to talk to you about risk tolerance. And I'm going to talk to you about risk tolerance right now. They're going to talk to you about saving and frugality, getting some money, and then they're going to say, here are the things that you can buy: stocks and bonds, basically. and a diversified portfolio of stocks and bonds, and the easiest way to get diversity is maybe buy an index, right? And I would encourage you to go to the White Coat Investor to learn more about this topic because they go into great detail about basically having a 3-fund portfolio and where you could buy like a total international bond index or stock index fund, a total, domestic stock index fund. And you could buy a bond index fund. But these things are not the full gamut of investing. And I think that that's where a financial advisor conversation falls direly short, because the financial advisor will not talk to you about the number one best investment that you can make, which is in yourself. And they will not talk to you about real estate investing, which is how more people have gotten wealthy in the world than any other type of investing. And they won't talk to you about the most common way that the quote unquote millionaire next door or the most common 1%er got wealthy, which is by investing into a business that they owned, personally held business. And they will not talk to you about other types of alternative investing, such as, I'm not even talking about crypto. I'm talking about more like gold and silver, investing in things like oil and natural gas, agriculture commodities, collectible things such as art, vintage cars. What is it? Numismatism? It's like something. It sounds like something that you need to take a medication for. But basically, investing in rare coins, maybe investing in timberland or things of that nature, like totally different. Those are investments, and I feel like it's not fair to have a discussion about investing when all you're talking about is, should I buy my stocks and bonds in a certain retirement account or a post-tax account? And should I do a Roth IRA or a non-Roth IRA? You see what I'm saying? There's limits. It's kind of like almost like the news media that you consume. Nowadays you have these two options, these two opinions, and it's like you have to choose between these, or the president candidate. You choose between these two candidates. When reality, there's an infinite number of candidates, and they're much different. The two options that are presented to you are more similar to each other than they are different. And there's these other vastly different options, which I personally am doing. And I think that the people that are generally really getting after it, and then like people that are buying sports teams, for example, like that's a type of investment. And aircraft ownership is a type of investment, and you can do litigation financing. You can invest in music royalties. You could buy wine and invest in that. You can buy non-fungible tokens, right? Those are totally different types of investing that I'm going to just not dive extremely deep into. It's fairly high level because we could talk for hours, probably weeks. But before we go into those types of investing, the first and most important thing is to know yourself and understand that any kind of investing includes a component of risk. So what is the risk? We've all heard that phrase, risk. There's a component of risk in investing, right? But there's, to me, two different types of risk. One is losing the money that you invested. And the other is losing more than what you invested. So, for example, if you buy a stock and the company goes bankrupt, then you lose the money that you invested. But because you are a stockholder on a stock exchange, while the bank is going after the company that went bankrupt, they will not come to your house and knock on your door because you are a part owner of that company. Your stock value will just go to zero. if you're buying on the regulated stock exchange. On the other hand, if you buy part of a company that is personally held and you are personally guaranteeing in some way a component of a loan that the company holds and the company loses everything, then there's a potential open door for the bank to come asking for payment back for the loans that company had from you, right? So first thing, anytime you're talking about the risk of investing, it's one of those two risks. You're either going to lose the money that you invested. And so you want to ask yourself, with this thing that I'm buying, do I have the potential to lose what I have invested? Or do I have the potential to lose more than I've invested? And then you have to ask yourself, am I okay with that? I personally am. I mean, I feel like in order to get to where I'm trying to go, I have to be okay with some of that component of risk. But then it's about managing it. And it's also not fixed. So it's very personal and very dynamic. Risk is in risk management. So for me personally, when I was 31 years old, I was just out of residency. I had basically nothing. I mean, I told you on the last episode, I had gone from a negative net worth to a positive net worth. I did have some investments. I did have some cash and some real assets. But the main things that I had is I had spent the last 13 years of my life investing primarily in myself. I'd done a lot of good job educating myself, and I was really prepared when I graduated mentally to handle the first paycheck, right? And I didn't blow it. And I bought the small house, and I lived the simple, frugal life, and I invested really hard because that was the time for me to invest really hard. So I had a good paying job. I also had life insurance. So if I died, my family's taken care of. Disability insurance. So if I lost the good paying job, I would still be covered. And I had a willingness essentially to hustle. That was the time in my life to take big swings, because what could happen? If I lost the money, then I could recover, right? So fast forward, a few years or a few decades, and things are very different. My risk tolerance would change. So even a few years forward, now my kids are older. I have now made the amount of money that I've made over the past 5 years. I've spent that time, and I have a desire to not lose that. I also have certain business obligations. My risk tolerance has changed. So what makes sense at 31 doesn't necessarily make sense at 40, may not make sense at 60. So risk, I would suggest to you, is not bad. Smart risk is definitely how you grow, and it will be necessary in order for you to invest. But risk is something that you manage. It's not something that you ignore. And it's not something you bury your head in the sand. And my dad told me that sometimes I move really quickly. And I asked he said that most people like to have firmly a hold of the next rung of the ladder before they let go of the last rung. And he told me he thought that I was sort of swinging through the vines in the forest like a monkey, and letting completely go and expecting that next vine is going to come. And maybe there's a certain element of my life that is actually kind of like that, where, you're the construction worker on the top, and you're the next boom is just moving in place for me to step onto the next boom. And I'm not necessarily arguing with that. And I sort of feel like I have been somewhat protected in life by basically providential means. Although I've been through tough times and tragedy and things like that. I think that there's definitely something bigger going on. There's something bigger than just me. But that's not my investing strategy. My investing strategy is not just take uncalculated risk and expect God to figure it out for me. That's definitely not my strategy. And I had then to have some conversations with my dad about, no, here are the risks that I do understand and I have calculated, but I understand all of these other options and things that are pivots and ways out. And to a certain extent, also having multiple different streams of investing might seem a little scattered. It's if one area kind of fails, it doesn't work out, then there's a buffer which can be covered by the others. And so we've kind of moved past that. And then I asked my wife in preparation for this episode, I said, who do you know that has a higher risk tolerance than me? Because in some regards, I'm looking around at my personal relationships and just general people that I know around me. And I move more boldly than almost everybody that I know. And she said nobody, which isn't necessarily good, right? At first blush. But then I said, so would you consider me be a risky person? And she said, no, I wouldn't, right? Because I'm not a cowboy. It goes back to managing risk. So being comfortable having an element of risk in your life and being smart about how you manage it are two very different things. There are people that do risky jobs and love it. And I might love those things too, but I wouldn't do them right now because they're not they don't fit with my overall self. So for example, like I'd love to go to Mars, right? And I'd love to be an astronaut. But I would never do that right now because I have certain responsibilities. I have an 8-year-old and a 6-year-old that I'm not going to leave hanging. I might, but it's not going to be because of me doing something dumb, and it's a time in my life where I want to be present for them. Now, at some point, they're going to be grown, and I may, you have people that are younger that they're not married and they don't have children, or most importantly, probably don't have children, and those are generally the people that you find appropriately so taking occupational risks like that, and working in jobs that, while they might be fun, they might have an element of risk. And you think, and then, you get older and a lot of people, they settle in and they would not take increased risk. However, it may be reasonable for somebody to do that when their kids are grown and, they're off, when they're off of the dependent from the IRS standpoint, they're also off of the dependent for you from other things, but you want to be there for them. But, here's to make it personal for me, right? One thing that I hear a lot is you talk about flying. So I fly almost every day. I fly a helicopter, and people are just, when I leave and I'm driving somewhere, sometimes people say, safe travels, especially if you go on a long trip. They'll say safe travels or whatever. But they always tell me, oh, fly safe, right? Because there's this unthought that what I'm doing is riskier. And the reality is that I lost my mom in a car accident on the interstate. Single vehicle, sunny day, flipped her car, was ejected. And she was 49. And meanwhile, my grandpa bought his airplane when he was in his 60s and spent several decades flying, thousands of hours. My dad has had his license, flies a lot. I fly all the time. My wife has her license. There's a feeling within general aviation that possibly a minority of pilots cause a majority of the accidents, right? But that's not to say that I'm just some safe pilot that's going to be protected because I'm maybe in the majority of people that consider themselves safe. And, different things that people say can age poorly or well based off what actually happens in the future, right? And the thing is that accidents do happen. And so some of that stuff is not just a specific 100% risk or zero. Because the thing is, there's a percent chance that my mom dies in a car accident in her lifetime. And there's things that she could do that would increase that risk or decrease that risk. Driving without a seatbelt, driving recklessly, drinking and driving, things like that will increase and decrease the risk. But it won't make it 100 or zero. But then at the end of the day, it is 100 or zero. It either happened or it didn't happen, right? And so the same thing is also true with things that we do in surgery. So we have a certain percent risk of DVT after varicose vein procedure. We have a risk of infection after we make an incision. We have a risk of an anastomotic leak. Those risks, when they happen to the patient, it's not like, oh, you have a 1% DVT. They either have it or they don't. But when you take 100 patients, there's a percentage of them that do or don't. So when you're taking these risks in investing, the question is, how are you going to feel when it actually happens? But you got to understand that also it most likely is not going to happen. That's a difficult thing for a lot of people to kind of wrestle with. But I think it does help on one hand to think that it's not your money in the first place. So that's a powerful, when you feel like you're a steward rather than it's like my money, that helps you to say, and you read what's the Bible say, right? About the stewardship discussion. God expects you to get a return. I mean, because there's 3 servants and they're given a talent. So a talent is not a talent like that we think about. It's actually a unit of gold. It's like a unit of weight. And it was basically like $1 million at the time. One guy's given 10 talents. The other guy's given 5 talents. The other guy's given 1 talent. And master goes away, comes back and says, show me what you did. And the first guy, I took 10 talents, turned it into 10 more, doubled it. The next guy, 5, I turned it into 5. And what the master said to those 2 guys is, well done, good and faithful servant, enter thou into the joy of thy Lord. And the funny part about that story and what it pertains to the things that I was just talking to, I mean, this topic is basically risk tolerance that we're talking about is that the day in June 13 years ago that my mom passed away, I came into my house and all her sisters were there. And she would text me a Bible verse daily. And I didn't really know that it came off this tear-off little daily calendar. And it hadn't been torn off yet. And they tore off and turned it to the day that she passed away. And they brought it to me and they said, hey, look at this. Isn't this incredible? And what it said was Matthew 25:23. And it said, well done, good and faithful servant, enter thou into the joy of thy Lord. And it's like the day that she passed, and they're saying, well, she's in heaven. She was taken home. And I did not want to hear that. I was very upset about it. I was like, she has Bible verse all throughout her house. Like this is not a message from God. And you're talking to a guy that just like is 23 years old and just lost his mom Monday after the first day of med school, just started my internship, and a couple hours into it, get a call, from my dad that's just like changes your whole life forever. So don't tell me that. I don't want to hear it. How could this be? Well, then the rest of the week goes on, and my dad had given a topical presentation, and he had used a picture that had an inscription on it. And it was that, along with other paraphernalia, was present in the car. And what he was talking about was, what's the point of life? What's the point of what you do? And he had a lot of trophies that were in the car. And they were trophies from when he was in FFA as a kid. And they had, men standing on top of them, cheering, raising their arms and stuff. And his point of his presentation that he had given was that those trophies were sitting out in the barn and they were all like dirty and dingy and rusted. And those trophies and the glory and all that's going to fade. And then what's going to last is basically what you did for others and what you did for God. So your service for others is basically how you act that out. Well, the picture, my mom had breast cancer like 3 years before this all happened. And so she went through chemo, she lost her hair grew back. And it's weird because my dad went to the wrecker where they had hauled the demolished car. And my mom had been ejected. Yes, she wasn't wearing her seatbelt. A semi driver had witnessed the accident and actually had a conversation with my dad. And definitely she was alive for a few seconds, but was unconscious at the scene. So another physician had actually shown up, was driving, and that was there on the scene. Of course, they launched the helicopter, but then they didn't take off because she'd passed. So, but it was remarkable how really limited her injuries were in terms of like how her body basically looked fine. But the car was like destroyed, and it had gone like end over end, and it was crazy. Well, she'd been ejected and it was probably like 30, 40 feet away from the car, and the trunk had been ripped open. And so my dad went to talk to the wrecker, and somebody that he knows from our small community. And he said, by the way, I found this stuff. And he had a box of stuff, and gave it to my dad. And it was the stuff that was in the trunk. And the trophies, if they were dirty and dingy before, they were destroyed, broken off. The little men, with their heads broken off and their arms and limbs broken off, and the trophies just demolished. And the guy at the record said, I've got one more thing for you. There's this. And I found this laying basically next to my mom's body, kind of far away from the car. And it was the picture. And the picture was of a person embracing Jesus in the clouds. And again, I've talked about too much for coincidence, but at the same time, can't say that I saw the laws of physics be broken, right? But too much for coincidence. The back of the head kind of looked like my mom's head after she had chemo. More importantly than that, there's an inscription. And on the daily calendar, Matthew, with the first servant, 10 talents. Well done, good and faithful servant, enter thou into the joy of the Lord. And the inscription on the picture is 2 verses later, the second servant. And it said, well done, good and faithful servant, enter thou into the joy of thy Lord. And so then I said, I give up. Like I actually cannot deny this. And this is this has been something that's been given to me to show me some clarity in this moment, and to explain that tragedy in a believer's life isn't always tragedy. Sometimes it's time to go. And her purpose had been accomplished. And then we had a funeral with the line that stretched all the way down the street, and over 1,000 people showed up, and my dad got a sympathy card, at least one every day for, I believe it's like the next 450 days, over a year. until the sympathy cards started spacing out to have a couple days in between them. And my roommate found Christ because of that experience, and it changed my life because I was just kind of farting around, and it was an Ebenezer, basically for me. And so that's a story about investing from the Bible. And there was an expectation for those investors to get a return. And investing to get a return is not wrong. But you have talents, if you will, time and money. And I think there's an element of accountability that at some point you're going to have to stand and say what you did with the time and the energy and the talents that you had. And I think there's an understanding that perfect, efficient management of our life is also not the primary goal. And I say that mostly because of illustrations with Mary and Martha. Martha's running around the house trying to cook and clean and get things done, and Mary's just being present and spending time with Jesus Christ while he's available. Martha's mad, I'm sorry, and tells Jesus to do something about it. Tell her to get to work. And he says that she chose the better part. And so you got to make your own decision. Fortunately, I have a hard enough time putting too much pressure on myself for how I spend my time. But I know that at this point in my life, there's a certain amount of balance that's required. There's kids that need to, I have a time to spend time with them now. I have, my dad, my other family members, my wife, my grandparents, that I have time, that it's very important that the big buckets get filled first, and then there's time for the other things. But how many days, how many hours is the right amount of hours to play Mario Kart in a year, and just totally waste time? And what is the right amount of time to work, and what's the right amount of money to make? And the other story about Mary is that she anointed Jesus' body before he was crucified with expensive oil. And of course, Judas Iscariot was somewhat indignant about that, as he said, well, that could have been sold and given to the poor. Right? And I think it's so funny. I had actually someone that I talked to not too long ago that I would say is too hung up on appearances, in my opinion. And I would say that straightforward to the person. But anyway, we were talking about aviation, and we're talking about the cost of it, and I was talking about time and cost and balancing things. And then somehow there was like thrown in there, oh yeah, and that could be sold and used for good. And I'm like, this is not the poor are going to be with you always. You need to give. Obviously, you need to care about others. That's like core to what I'm saying here. But to think like that is not the way that, for example, Jesus thought, because Jesus said that she did the right thing, with sort of wasting, or using the very expensive oil, which I think the time, I can't remember. It was like a year's wage, I think, was the value, the average year's wage, maybe for the oil that was used. When you're taking this back to investing and risk tolerance, okay, I think that when you have a mindset like what I just described, if you do, it's easier for you to realize, like, in 100 years from now, nobody is going to care what you did at all nobody's going to care about the money that you made, how you invested. Like, no one's going to care if you made a mistake, and so it should allow you more boldness to be able to, get yourself right financially, depending on where you're at, get yourself out of personal debt, like unsecured debt. When I say unsecured debt, I mean things that you can't sell something to pay it off, right? And then after you get yourself out of unsecured debt first, which just to be clear, debt for student loans is unsecured debt. You can't sell anything. You have to work your way out of that hole. But you get yourself out of unsecured debt and then get yourself out of the secured debt that you have on depreciating assets. So for example, cars would be a good one, boats, anything like that. Don't take out loans to finance a vacation or whatever. And then you have appreciating assets, and then you have cash flowing assets. So there's unsecured, and then there's secured on a depreciating asset, secured on a appreciating asset, and then secured on a cash flowing asset. So for example, an appreciating asset would be your house. If you have debt on your house, it's going up over time, but it's still, maybe it's a liability depending on how you define it based on our last episode, because it's costing you money every month. So it's like a forced savings plan, but you're buying something with a loan that is appreciating, may or may not be appreciating faster than the loan interest rate is. And then you have what I try to buy, which is an appreciating asset that is also cash flowing. And that would be like investment real estate, right? So you have to start wherever you're at, kind of get yourself to the core, and then realize where you're at from a life perspective, risk tolerance. What's your age? What's your runway? Who's around you? Who's depending on you? How can you insure yourself against terrible things that would happen? So for example, if you're a high income earner, insuring against your job going away, disability. I have the issue with my hands that I've talked about on this podcast, and it makes you understand that disability insurance is very important. It seems very expensive, and it is, but it's too expensive not to, because what you're insuring against is financial catastrophe. Okay. So if you have a $2 million building and a building burns down and you still have, $1.5 million of debt against it, that's financial catastrophe for you. But if it burns down and you have insurance to replace it, and you've insured against business loss and all these things, you can, in the 21st century, you can insure against all that stuff. And there's still risk, but it's more becomes business risk of vacancy, et cetera. We're kind of moving from a perspective of talking about risk to actually talking about the actual investments. I think I have some very clear thoughts on what's the difference between leverage and debt. And I have some very specific thoughts on tax management and how to really manage those two issues that I think are going to have to get saved for separate episodes, like one about debt, one about tax management. And I would like to close out this episode by kind of going back to what I was saying at the beginning is most financial advisors can't talk to you about all the different types of investments. So I have essentially a list of different types of investments that you could possibly make. And it's not necessarily a comprehensive list, but it's a point of saying that there's not just A and B options. There's C through, almost infinity. And Warren Buffett says the best investment you can make is in yourself. If you're listening to this podcast, you may be a doctor already, or you may be working that direction, or some other type of professional. And you think about the cost that you actually put into doing that thing. And college isn't the answer, but investing in yourself is. And there's a big difference between just going to college and getting a degree and truly investing in yourself and like imagining what you're going to be doing with that degree. But I have this list, basically, there's stocks and bonds. So stocks are equities. It's a portion of a company, a percentage of a company. And you can buy them as individual stocks like Apple or Tesla, or you could buy them as an index fund. So an index fund is something like the S&P 500 index fund. So that means the S&P 500 is the top 500 market cap companies in the United States on a specific index. And they're purchased and continually rebalanced in that percentage. So if a company is shrinking or contracting, another is growing, it's buying a higher percentage of the stock that is basically growing. And you can have a total stock market index fund where you buy all the stocks that are publicly traded in the percent that they exist. What that means is you're going to be buying some stocks that are the company is shutting down and going to zero. But at the same time, when that happens, another company is taking advantage of that opportunity and is growing. And Warren Buffett has also said that for the average investor, investing in index funds is probably the way to go. And he said, I think he said if his wife was gone, I don't want to misquote, but if he was gone, he would just tell his wife to buy index funds. It's a strategy, right? And you can also buy funds that are called mutual funds that are managed by a person that's trying to beat the market. But the problem is almost no one in the long term beats the market, and especially not you. Okay. So if you're picking your own stocks, are you going to, or are you not? I don't know. You can't do insider trading, right? So if you have true insider knowledge, you can't do that on the public market. But if you know about certain things or you have certain beliefs, yes, you could potentially do that and try to do that. But like Peter Lynch, I think with the Magellan Fund is a good example of 17 years, I think, of beating the market. And then, okay, fact check me on this, but I believe it was over a period of a few years after that, regressed to essentially market returns. It's very difficult. And the people you're competing against in terms of trying to, quote unquote, beat the market, especially if you're like day trading and whatnot, they are like extremely smart people that are wearing suits and working downtown in New York City. And all they do every day is look at spreadsheets and try to identify values and things like that. I don't invest in stocks in that way at all. I invest in stocks for the long term and primarily as a diversification away from the other things I'm doing. And it's a way to save money for me, but it's not like a real investing strategy. You're just kind of buying because all you're getting for a return is it's a non-leveraged, obviously, asset. And so you're getting, whatever return it's going to give you, which is usually less than 10% long term. And what you're doing is you're just trying to keep up with inflation, maybe stay a little bit ahead of it. And the question is, do you believe in the future of the American economy, which I have no reason not to believe in it? The American economy is like the most, the crazy social experiment ever, the melting pot of the United States. It's a very blessed nation, and it's been on a tear for a couple centuries. And I think that we have more runway. There are certain types of headwinds, and especially when a society starts to take from the producers, that's where we're kind of at, and that can become a problem that could start a spiral. But again, I would say if I had to pick a country, I would obviously pick the United States. In the field of stocks, you have dividend stocks, growth stocks. The difference is one's a mature company that's now chipping off a return. The other one is a company that's still growing. So usually any returns that it has, it's bringing back into the company. And then, there's a concept of value investing, but again, it's hard to do value investing as an individual investor. You can, but you have like a price to earnings ratio, and you're trying to determine when that price to earnings ratio is low enough. So for example, if I'm selling, and you need to think about it that you're buying a company, right? If I'm selling you my company, right? And I have a restaurant company and I have $1 million of income per year and I have $900,000 of expenses. So therefore I have a net income of $100,000 on my company. How much would you pay me for that company? Right? Or how much would you pay me for 5% of that company? Right? So if I wanted to maybe cash out a part of my company and I'm a mature company and I say, I'll sell you, 20%, a fifth of my company. So you're going to get $20,000 a year as long as everything continues the way that it's going, right? But what are you willing to pay for that $20,000 a year? And that is where your price to earnings ratio comes in. So how many total stocks are out there, for the whole company? What percentage of the company are you buying? And dividing that into what it's showing for earnings. But there's so much that you don't really know. Like for me personally, I don't know who's actually running that company. And I don't know what the inner workings are. And there's a lot of things that you can do with accounting. So I tend to invest closer to myself and invest in things that are more in something that I can control. Now that's a lot of pressure on me, because for example, if I invest in a commercial real estate asset and then I lose my tenant, then I have, I've gone from a property that had a loan on it that was cash flowing to something that's, really a liability for me. That's how you can end up bankrupt, right? And you cannot go bankrupt if you don't owe anybody any money. So that's Dave Ramsey's strategy, right? He went through bankruptcy and he said, never again is that going to happen to me. And I don't want that to happen to me when I'm 60, but when I'm 31, and even if I lost everything, I would still have my job that I had invested in. That couldn't be taken away from me. Again, this comes to your risk tolerance, right? It's a very different scenario. So, and I'm living on a farm that I don't actually own. My grandpa still owns it. And might I even think more differently about my risk tolerance if I were ever to buy the farm from them? Because right now, I'm not risking the family farm with any of the potential risks that I may be taking with my investments. We'll talk about that in the leverage episode a little bit more. I'm going to get through this list and then close it out. But your other types of things you can buy would be bonds, right? Bonds like a loan to somebody, like, for example, government bond, a U.S. Treasury bond where you're borrowing money from the government. You can also borrow money from corporations, or you can have higher yield, more junk bonds, or you can just straight up loan money to somebody. And I've also done that. And you can definitely get a higher return, but there's a lot more, risk associated with that. Now, what's your risk? Your risk is you lose your principal that you invested, but nothing more. It's not like you took out a loan against your loan, right? You can also buy on publicly traded exchanges REITs, which are real estate investment trusts. There are publicly and non-publicly traded REITs, and you can buy exchange traded funds, which focus on specifically specific commodities. Like you could invest in just tech or healthcare or whatever. And those are different types of funds buying against stocks that you can invest in. And then you have a whole nother category, which is real estate. And that's mostly what I do. But even within real estate, there's so many ways you can do it. You can do land, like flip, buy, hold. You can develop. You can buy commercial real estate, which is where your tenant is a business. You could buy residential real estate that could be a single family home up to fourplex, multifamily, big apartment complex. You could be short-term rental, Airbnb, could be destination. You could be as involved or not involved as you want to be. You could also invest in a group and just put your money into a group investment. That would be called a syndication. You could buy farmland, timberland. There's crowdfunding platforms like Fundrise. Those are, again, so more different. There's like more different within this category than there is alike. And that's just one category of types of investments you can make. Then, if you've ever heard of The Millionaire Next Door by Tom Stanley, I believe is his name, great book. And what he talks about is the blue collar nature of most wealthy Americans. And they basically bought and owned their own business, which was usually a boring, profitable business, meaning not a restaurant. It was something more along the lines of manufacturing, or, it could be like a boring, profitable business in my mind would be a laundromat. Okay. Something like that. Even more so if you can niche into something, you have a business that makes some little niche product. The nice thing about it is it's stable. And since it's boring, maybe there's a moat around it that other people can't necessarily easily get in or don't want to get in. And, you have a long-term relationship, just take care of people. I've got friends that have businesses doing, selling machinery for, certain industry or pieces of equipment, stuff like that, that that are necessary, but they're not commodities. Okay. There's a difference between investing in a commodity, which the price is dictated by the market. So for example, if you're raising hogs, all right, that's a commodity. You're going to sell it. If you're raising corn, you're going to sell it for the market price. And the problem with a lot of those things is you have to commit to buying the hogs and raising them before you really know what the market price is going to be. So you then have to worry about your marketing a lot more and potentially, selling your futures and hedging and things like that. So there is a difference between selling a commodity as your primary business and something that's less so, where you can change your price if you need to. But you can have direct business ownership. You can also take your money and invest it from a venture capital perspective into something that you think is going to take off. Sometimes that could be called also angel investing, private equity funds. Generally, what private equity does, and a lot of you have seen it in hospitals, is they try to come into a profitable business and usually use some leverage on it, and then sometimes put the business in a worse space, but then sell the business. It works to a point, but it's not working super well in healthcare right now, as most of you know, because the people that end up running the business, like what I've seen them do, is they'll come in and take like a certain department and they'll just close it down, fire all the people, fire a doctor and the associated staff. But then what they're trying to do is real quick sell the business before it becomes obvious that the revenue stream has been lost. But they showed that they decreased their expenses by firing a doctor. Well, if you fire the doctor, but you lose the revenue stream, like obviously you didn't do well. And if they don't sell the business in time, then they're going to be left holding the bag. Or if they sell the business real quick, the next person that bought it is going to be the one holding the bag. But either way, that's not real investing. Don't do that. Lending to other people, I had on here commodities and hard assets, gold, silver, precious metals, oil, natural gas. There can be certain tax advantages to those things. Look it up on your own. You can buy agricultural commodities, corn, wheat, cattle futures, collectibles, art, vintage cars. I have a lot of people that have bought those things and they've made good money. Airplanes, you can do the same thing. A lot of airplanes are worth a lot more now than they were when they were new. I talked about rare coins. Crypto, the thing about crypto is that it doesn't make any sense to me as an investment. I have lots of friends that have made millions of dollars on crypto, and they swear by it. But again, it doesn't really make sense because crypto in and of itself it's either a store of value or it is a currency. And either way, it's not generating a return. So, and I feel the same way pretty much about gold. You could take gold and you could use it as a currency, and they make little gold things that you can buy that have break off little, they've been stamped so you can just break them into smaller pieces, like in a apocalyptic, scenario, should we need to be piecing this stuff out. I don't know. I would rather own an asset that is generating cash flow for me. That's my core concept. Is I do cash flow, buy and hold, long-term investing, if you had to sum it up. And crypto doesn't fit that mold because it doesn't really generate you a return. I mean, it's kind of, there's an element of tulip fever. Right now, an alternative investment that I have is in cattle, right? So I'm buying cattle and I'm buying very, very niche cattle. So they're Scottish Highlands, purebred. And of course, the one type that I wanted are the silvers. And of course, they're by far the most expensive and theoretically might work out. But I think the Highlands are extremely popular right now. So the prices continue to go up and up and up. But at what point is this going to be like a tulip fever implosion where the cattle prices actually drop? Because my cattle, do they really have any true value greater than another cow? There are some things like I could tell you, the horns and the dual hair coat and the meat qualities standing generally second to Wagyu in most major tests. I could tell you that. That's due to the double hair coat causing a lower stripe of back fat, more marbling that goes into the meat. With the horns, they are more heat tolerant. With the hair, they're more cold tolerant. They have small calves. They've been basically raised on the Scottish Highlands for hundreds of years, and they've been left to fend for themselves. And so they're one of the least genetically messed with breeds of all, and you don't have to pull their calves, and they're moderate framed. So although being big and growing fast is effective for feeding America, if you want to have a small acreage farm and you want to have an animal that their foot, because they weigh 1,000 pounds instead of 1,500 pounds, each individual foot is only 250 pounds when it steps, right? Instead of 375 pounds, it's potentially easier, less compaction on your ground. And so I could say all that stuff. I don't know if I left anything out. I think there's others. Oh, they have the highest IQ of any cow, right? But they're still stupid cows with an IQ in the 40s. So don't forget that. I could tell you that. And, but at the end of the day, if you're trying to put just pounds of beef in your freezer, the Highland is not the very best tool to do that. It will do it, and it will do it in a quite efficient way, because you know how else do you turn sunlight and water through grass into beef that you can put in your freezer? Cow is an amazing animal for that, no matter what the breed. But the fact that the rates for these Highland cattle are much higher right now, there may just be a bubble, right? And or maybe not. Maybe it will continue and then stabilize at the new higher things. But I'm not investing money in these cows that I can't lose. So if it goes down, okay. But the tulip fever story, apparently in Holland, I can't remember exactly when, but hundreds of years ago, tulip bulbs became like a currency, and they're being traded and sold, and the prices just kept going up and up. And if you had a very rare type of tulip, you could breed them, but plant them and sell them for more money. And so some of these bulbs were selling for incredible prices. They're being like traded in like bars and taverns and stuff. And then all of a sudden, one day the music stopped, and nobody wanted the tulip bulbs, and it was a sell-off. And it's a race to the bottom. How quickly could you get rid of it? Because what you realize is it's just a tulip bulb, right? So same thing with a cow. Like, you have to consider there's always going to be a value to a cow. Like it has inherent value, but there's sort of a floor to that as well. And you just want to be aware of the things that you're investing in. So that's like, I guess, Bitcoin. There's also NFTs, which I feel very similarly about, but I feel obligated to at least mention. And if you don't know what an NFT is, good for you, but maybe look it up. Any other kind of blockchain kind of fits in that same category. Then there are vehicles for how you invest. And those are vehicles, but not the investments themselves. And here I'm talking about your 401k, your 403b, your 457 plan, your IRA or your Roth IRA, your health savings account, your 529 college savings plans. If you're a business owner, your solo 401k or your SEP IRA, your defined benefit pension plan, or if you're doing charitable giving and you want to do that in a tax advantaged way and you use a donor advised fund, those are funds that you can put money into, and then you buy things inside that plan or account or fund, whatever you want to call it. But if you have a 401k, you can still buy Apple as an individual stock in there, or you could buy a total stock market index, or you could just leave it in a money market account. And so don't forget that if you put money into one of those accounts, you still need to go choose your investments, and still could lose money, but probably won't, but you could. I talked about that. I also, on the topic of business, not you could own your own business, and that could be franchise or something else that you made, or you could have intellectual property, like you could invent something and have a patent, trademark, or a royalty, or you could buy somebody else's patent or somebody else's royalty from them, and that royalty could then be your ongoing income. Investing in yourself in education, courses, licenses, things like that, personal growth, the time that you're spending listening to a podcast that you're trying to kind of grow yourself. And then finally, like if you just have cash and cash equivalents, this is very low risk, also very low yield. And in this inflationary environment that we're now in, if you have cash, it's worth less tomorrow than it is today. So you have to have a reserve, right? Because my grandpa told me a story about somebody that he knew who was a mechanic, and he heard of this car coming. It was a very good deal that he could have bought, and he could have fixed up, and he could have made a very good return, but he didn't have the cash to buy the car and get it fixed up. So you need to have cash aside for buying opportunity, as well as for the downside risk of the things that might come up, both in your personal life, which is just like your emergency fund. But the bigger that you become, the bigger your net worth becomes. It's for your business potential issues that might come up. So you can take that money and hold it in a money market account, certificate of deposit, or you could just have a high yield savings account, or you could buy treasuries with it. But those are essentially like cash equivalents. Then I had just a couple more weirdos because you might be interested in it, somewhat unique just for your entertainment purposes. But, aircraft ownership, just a thought. Aircraft tends to appreciate over time. Because the cost to produce, and there's also barriers like the FAA, which is driving a lot of costs up because it requires so much work just to get something pushed through the FAA. You could buy cattle, have a breeding plan, things like what I do. We also buy tax liens. It's sort of a litigation finance sort of a thing where if somebody else didn't pay their tax on a property, you have the government wants that paid, and you have a legal right to buy that tax lien, and then you can charge a certain amount of interest, and your first lien on the property in front of the bank and in front of anybody if you buy a tax lien. So I have a little bit of money invested in tax liens. There's just, my point of saying all these things is to tell you that there's infinite amount of type of investing that you can do. You could and once you get to the point where you're kind of rolling it all up, you can buy your own sports team if you want to. But I got my own other opinions about that. Maybe a better option is domain name investing. People can make money doing that. I used to have sports cards, right? I didn't make any money off of that. Buying luxury watches. It's good when the market's up. But when the whole market goes down, the things that are those kind of specialty things are going to be the ones that are probably going to suffer the most because there's not that inherent underlying value, So again, invest in anything at your own risk. And I'm not telling you to any specific real estate investing advice or investing advice in any other category. But what I am telling you to do is know yourself. And understand that at the end of the day, the biggest return on investment isn't measured in dollars. It's measured in your freedom. So the freedom to take a mission trip without checking your bank account, the freedom to cut back on your clinical load when your kids are a certain school age, the freedom to invest in other people around you, your patients, your staff, your community, right? That's the real ROI. And so learn about yourself, consider what you actually want, consider that you're potentially just a steward for the resources that are in your control for the long haul. And you have to think, I have to think now, I'm 36. I've got 4 living grandparents. That's pretty incredible. But yet I lost my mom when I was 23. So I have to consider, well, maybe I'll live to be 100 or maybe I die tomorrow. And all I can do is manage the resources, which I do think talent is a good word. The skills that I have now, as well as the money that I have now, relationships that I have now, and more importantly, the 24 hours that I have today. And in a way that I can live with. And hopefully I do live to be old. And when I'm old, I can look back and basically, I love that quote of the goal is not to arrive at the end of life in a safe and well-protected package, but rather to come skidding in, worn out, used up, and saying, whew, what a ride. That's how you're thinking of managing your day today. And that's really all you have is just today. So I really appreciate you joining me on this episode where we talked about investments, all kinds of investments. And I look forward to the next episode where we can talk about the concept of debt versus leverage, when I have some very specific and unique thoughts that it took me a couple decades to sort of clarify. And then we'll talk a little bit more about like what I specifically do. Again, not telling you to do it, but managing taxes for a high-income professional could become one of the best things you can do with your time in terms of your efficiency. And several other topics to come in this money mini-series on the Rural American Surgeon podcast. So thanks for joining us, and I'll see you next time on the show.